Hello, everyone, and the critically important CPI numbers are coming out tomorrow. This could determine the future of rate cuts, if we are getting a rate cut or not, because it is projected that the inflation is going to be pretty bad. Yes, indeed. Let's actually take a look. Not super bad, but how we perform against those projections is very, very important. The July CPI report is expected to show inflation accelerated amid mid-tariff pressures. Now, let's not forget, June's CPI was above the projections. And if July's CPI is above the projections, I think our rate cut percentage goes down from like 80% that we're going to get a cut to maybe about 50% that we're going to get a cut. So it is very, very important. So July CPI is expected to show prices rose at a faster clip annually reported to June. So they seem to be accelerating. The report due Tuesday at 8:30 a.m. Eastern Time comes as investors stay alert to how much President Trump's tariffs are starting to affect consumer costs. Now, once again, the baseline tariffs actually started to come in May, but let's not forget, companies like Apple and many others bought a ton of inventory. So they don't have to buy new inventory after the tariffs, but now those inventories after 2 months are running out. According to Bloomberg data, headline CPI is expected to have increased 2.8 year over year in July, up from 2.7 rise in June. On a monthly basis, prices are forecast to increase 0.2%, a slight downturn from 0.3. Now, if you actually look at oil, which actually affects everything, in July it was a little bit higher than June, but still well under 70. And now, the first days of August, it's actually gone back to lower 60s, instead of upper 60s. But for July, that seems to have risen a little bit, so that'll contribute a bit as well. And of course, on a monthly basis, prices are forecast to increase 0.2, a slight slowdown from June's 0.3. And I do actually think that's because June was quite a bit bigger than we expected. But if July's actual numbers come in and it's higher, like 3, I definitely think the chance for a rate cut goes down. And of course, the lower gasoline prices for the summer and expectations of moderately softer food inflation. Now, not really sure if the moderately expected food inflation is actually going to happen, because stuff that we import, like especially the more tropical fruits, are definitely going to go up. The core CPI, that's excluding housing and energy, is actually way, way worse. On a core basis, which strips out volatile and food and energy prices, the annual inflation rate for July is expected to tick up to 3.0 now. 3 is obviously a big number that the Fed actually watches. It's up from 2.9. So June was already pretty close. But if we tick up by more than 0.1, let's say the overall goes up to 3 and the core goes up to 3.2, then the Fed governors will know that the tariffs are indeed responsible for the inflation, and they're probably not really going to cut rates. Core prices are also projected to climb 0.3 month over month, outpacing the previous 0.2 rise seen in June and marking the strongest gain in 6 months. Now, obviously, that could definitely be due to inflation. Powell will probably hold off for another month, saying whether we don't know if it's inflation or not. But let's not forget, August inflation report is going to come in before the next FOMC meeting, and that's why it's going to have such a critical effect. In June, signs of tariff-driven cost pressures emerged. So that June's report was the last one, with apparel prices up 0.3 on a monthly basis and footwear rising 0.7. Now, a lot of clothes and apparel are obviously manufactured overseas, and that's why. After several months of declines, furniture and bedding prices also gained 0.4, reversing May's 0.8 drop, another signal that these higher costs are starting to reach consumers. Like I said, as you run out of inventory, or as you run out of the cheaper cost inventory and you have to get more expensive cost inventory, including like materials for things like furniture, like lumber and things, are going to get expensive because we do import some of that stuff. So those building materials are going to get more expensive, so those things are going to get more expensive. The July CPI will bring further signs of higher tariffs pushing up prices. Wells Fargo economist Sarah House wrote last week, "It is still early in the price adjustment process to see how higher import taxes will ultimately be distributed between customer domestic sellers and foreign exporters." I think they said something like 80% of the cost goes on to the importers, which will be passed on to the customers. At the same time, growing consumer fatigue is making it more difficult to raise prices in general. because they don't want to lose market share. We continue to expect inflation to pick up, but not ratchet higher over the second half of the year, with both the core CPI and core PCE deflator returning to around 3% in the fourth quarter. As long as we don't go too much above 3 by the end of the year, I think we're fine. But that does actually counteract some of the progress we've made with the poor labor numbers. See, like if Trump wants to cut rates, he should have just kept the person who gave him the poor labor numbers, because that's how you actually get Jerome Powell to raise the rates. So Tuesday's report is set to arrive amid ongoing trade developments that could further alter the U.S. effective tariff rate. For those of you that don't know, they extended the Chinese hiatus because they don't really want to deal with that right now, and I don't think they're going to make a deal anytime soon. So I think they're just going to keep extending it. Still, markets are increasingly betting the central bank will lower interest rates at its September meeting, driven largely by concerns over the U.S. labor market's health after significant downward revisions. CPI could leave the Fed with dual headaches, Citi analyst Stuart Kaiser wrote in a preview of the report, adding investors will likely focus on updates to core goods prices. So, because goods did tick up, as long as they didn't tick up more than 0.1, I think we're okay. But if they did 0.3, I think 3% is kind of the magic number that we really don't want to go past. And I think we need September or the August report to remain kind of low, or around 3 or less, or maybe even 3.1. I think if we go 3.2 or higher by August, by next month's report, we are seriously in trouble in terms of the rate cut. So as of Tuesday afternoon, investors are placing an 87% probability the Fed cuts rates by 0.25 at its September policy meeting, up from 57 last month. And that obviously is because the labor markets got adjusted down. However, I think that 87% could easily go down to 57% if we come up with inflation numbers of 2.9 or 3. I think if it's 2.9, it might go down to 75. If it's 3.0, it'll probably go back down to 57. The thing is, I think earlier this year, the tariff effects didn't come into play, and also I think oil being at $56 a barrel definitely helped counteract some of these surging prices elsewhere. But now, since that's gone and oil's at 64, and maybe go up to even 65, 66, I think that's adjusted back to normal. And although OPEC is saying that they will continue to produce more oil, I don't actually think that's going to lower prices past the lower 60s, maybe upper 50s at the most. So that mitigating factor with gas prices is probably going to go away. I mean, month by month, it's different. If oil drops from 64 to 59 in August, obviously the August inflation report will actually be better. And if at any time OPEC decides to stop producing more than expected, then the market will obviously take a fall right now. So, people aren't too thrilled about the CPI reports. A lot of the economists are saying that, the next 6 months or so, we're going to see some of this inflation come in. And that kind of ties in because, if you really think about it, the inflation reports would actually stop once Jerome Powell actually leaves office and Trump's guy comes in. And that will actually help us cut some of the rates at that point, depending on how high inflation is. If we get rise over the next 4 months, and when Trump's guy comes in, it's at 4.5 or something, I think even he will find it hard to cut by the amount that Trump actually wants. Because obviously he wants the interest rates down at 1. He wants easy money so businesses can actually have expansion. But that would easily kick up inflation, that would actually rise the prices of basically housing by increasing demand. Because right now, demand for new houses is very, very low. The mortgage rate is high because interest rates are high. If you have to take a 30-year loan, obviously most of your payment is going to be interest, especially at the beginning. But if they go down to 1%, that changes drastically. But since the mortgage payments are going to be low, then the asking price is going to be higher because there's going to be more demand to buy houses, and more demand to buy houses means people are basically going to bid, as they were after COVID, 10, 20% above the price. Right now, because of the higher interest rates, they're not doing that anymore. Some people are coming in below price, and it depends on which area of the country you are. Some markets do remain hot. So at this point, I don't see too much downward potential for inflation, but I do see a lot of hot upward potential for inflation, depending on where the tariffs actually go. Hopefully it doesn't rise back up to 4 or more, but I think there is a possibility if the trade wars continue to go on. Remember, the tariffs on the baseline tariffs only 15-20%, but even that is increasing the price of a lot of things by a fairly good amount. Yes, there is going to be revenue coming back into the United States from the tariffs, but those will most likely have to be used to subsidize the industries that they hurt. Because remember, when he actually did the agricultural tariffs last time, he basically had to use the entire surplus of what he actually gained to actually bail out farmers. It was like $92 billion. This time, the tariffs are much more broad based. So therefore, he's going to have to bail out a lot of other industries that are going to really be suffering from his tariffs at this point. So hopefully, this doesn't affect it too much. But if it actually does, then we're going to have to reevaluate in a week or two. Like I said, if we get like a 3.0 as the CPI, we're definitely going to have to reevaluate the Fed stances and like how much they're actually going to cut rates, or if they're going to cut rates at all. And we'll have to look for like the health of the U.S. economy in the future, because I definitely think like if inflation bounces back like that, I think like people's spending is most likely going to go down at that point, and that might affect the entire economy. Maybe we'll get some negative GDPs, and then Trump will have to rethink his tariffs. Because remember, like tariffs don't actually matter to the national debt all that much. Like your trade deficit doesn't just go into your national debt. There is some like play with bonds that like if people are selling to you more than they're buying, then they're buying bonds, and in that way like it could increase national debt, but it's not really a direct relationship. So like the trade deficit is more or less just a number. I think like he's trying to get more industry in the United States, but I also don't think that's going to work. Like the chip stuff was happening anyways, because they signed that chips deal like 2 years ago, so that was happening anyways. And the other industries just really aren't coming back to the United States because the price of labor here is like way too much higher than those other countries. So I think like overall the tariffs are kind of like a hex on I definitely think the tariffs are kind of a hex on like if the crypto market expands or not, and it is kind of like preventing the crypto market from really blowing up. And they killed the momentum back in February, and we haven't gained it back yet. And I don't really see how we're really going to gain it realistically, like in the next couple of months. I'm still waiting for October, November for the ETFs, and hopefully that'll boost it up. But I definitely think some of the moves made so far by the SEC has definitely helped. You have like the staking stuff that they're really positive on. I think like they're probably going to classify restaking like that as well. So I'm actually kind of excited about to see what's actually going to happen, but I don't really see like huge positive momentum within the next 2 months. After 2 months though, as we get into October, November, Q4, which is usually pretty good for crypto, I think all bets are off. I definitely think we can actually make it a lot more. Like we can actually do a lot better, and we can hopefully hit 180K, which will cause the altcoins to explode. So that's the news for today. Let me know what you think. Like and subscribe, hit that bell notifications button. Thank you, and have a nice day.